Welcome everybody to our March mortgage talk with Melissa and me. Super excited to just be touching on the whole topic of taxes since it is the season of taxes. A lot of people have questions. A lot of people think they know things and it may not be correct. So Melissa and I are just going to kind of discuss different questions that people have and different things that need to be addressed and just educate you on this whole topic. It's important that you're making wise decisions. And when it comes to a pre-approval and buying a house during this time of year, it's just important to know what you need to know. So welcome, Melissa.
Thank you.
And yeah, so I'm sure you're getting lots of questions, being that it's kind of tax season. So let's maybe just dive into some questions. I'll start and then you can basically just start, addressing questions that you've been getting. But I do know that this is probably the most relevant question at the moment is, do I need to have my taxes filed before I get pre-approved?
So unless you're self-employed, no, you don't. If you have, if you're salary or you have guaranteed hours, generally, if we're looking at using an average, we would only use your last 2 years T4s. If your T4 hasn't been generated yet, so like if you're kind of right on the cusp, so like end of January type situation, we can even use your previous year's year-end pay stub in lieu of a T4. So if you are in one of those kind of buckets where you have maybe part-time or contract income and we're using an average, or your hourly or salary, we don't even need to see your tax returns more often than not. If you are self-employed, though, that's where things change. And yes, you do want to have your taxes done if possible. It really just depends on the time of year. But like right now, depending if you are incorporated or if you're a sole proprietor, that also kind of changes things. But ideally, we want to see that your taxes are complete and they're up to date if you are self-employed.
Now, what if your income last year or like 2025 wasn't as good as the previous years? Can you use that to your advantage in the sense that like, let's get pre-approved based on last like 2024 numbers, not 2025 numbers?
Really depends on how you're paid. So if it's guaranteed hours or salary, we can technically use your base rate. We don't have to use an average. So we could use whatever is indicated on your letter of employment in your most recent pay stub. We can just go that route if you feel like your average is not high enough. Most lenders want to see that if a previous year was higher, last year was lower, they're not always going to want to use an average of the two. They may use the lower of the two. So it really just depends on how you're paid and what that structure looks like to know whether or not that would even be feasible. A lot of times we will just look at if you receive variable income. So like a bonus, for example, if it's not consistent or if you've received raises that kind of throw off the numbers, we might just use your base salary in your pay stub. We always collect a 2-year average of T4s, your pay stub and letter of employment, and then we will determine what is the highest amount of income we can use for you, and we will do it that way.
Right. Now, do lenders use your gross or your net income?
Again, depends on whether you're self-employed or not, but if you are just a regular employee, then we use your gross.
Okay, perfect. Okay, I know the self-employed income is a little bit, maybe we need to do a completely separate video on this because it's very complex, I think, and there's a lot of moving parts to self-employed income. But is there anything specific that could be just an easy piece of advice for those who are self-employed?
Easy piece of advice would be to include your mortgage broker and your accountant in your planning before you actually complete your taxes, because he will be able to tell you one way or the other, okay, so if you want to qualify for this, you need to claim this amount of income, and then you can go back to your accountant and see for tax planning purposes if that makes sense.
Yeah.
The rule of thumb generally is either you're going to pay more money in taxes or you're going to pay a higher interest rate. That's kind of the trade-off when you're self-employed. So you have to
Right.
determine with your accountant or financial planner which option there makes more sense. Like, does it make more sense to claim higher income and have a lower interest rate, but you're paying a lot more in taxes? You have to see what that trade-off looks like, and
Yeah.
it's going to be individual. But my word of advice is to include both people in your planning so that you know how much income you should claim if you want a specific outcome, and then take that back to your accountant and say, does this make sense? Will this
Yeah.
work?
Totally. And I do think that's a really important element too, because the person doing your taxes can manipulate numbers to work in your favor if they know what the end result or what the expectation is. So, it's one or the other where you're going to give and take. But I always say, let the professionals tell you what is best for you. And that is not my forte. That's all her and the accountant. But it is super important to know these things, because I know that when we did some mortgage stuff, I had no idea that claiming what I claimed kind of hurt us in a way, me being self-employed. And so now I realize, oh, I didn't know that the mortgage person and the accountant should have had a conversation prior to, right? And so that's definitely a great piece of advice, I think, for those who may not know that.
It just makes it so much easier on you.
Oh, for sure. Yeah. And you don't want to go like, I wish I would have known. Now you know. We're here to help.
And it also helps with collecting tax documents on our part, because if you give the accountant permission, they can just send them directly to us, so that you're not dealing with everything in between, trying to send us all those documents. That can be pretty tedious. So if you make that connection early, we can just request the documents that we need. They can provide it directly to us. That saves you a whole bunch of hassle.
Yeah, that's the same with me. Like when I'm working with my clients and I'm like, if you're open and willing to allow me to chat with your mortgage person, I can deal with a lot of the stuff that maybe is more stressful for you, and then I can just have that direct communication, and then it's not overwhelm for them, which I think is appreciated in those scenarios.
Definitely. Teamwork makes
yeah. Will unpaid taxes stop me from getting a mortgage?
Again, it depends. So if we're not collecting your tax documents, we don't necessarily know whether or not there's a balance owing if you're not self-employed. If you do mention it to us, yes, it does need to be paid out. And it depends on how far behind you are in your taxes. Usually, like some of our bank lenders will allow us to pay out the most previous year's personal taxes. They will not go past that. So you may need to, get a loan from a family member or friend or something if you're doing like a refinance, and perhaps we can arrange for it to be repaid after. But on the person, like if you're just regularly employed, we don't necessarily know if you have a balance owing if we're not collecting tax documents. If lenders are not requiring it, we won't necessarily see that. If you are self-employed, usually, yes, they do want to see that your statement of account is up to date and that you have paid your balance. And again, if there's money owing, if it's from the most recent tax year, sometimes we can include that. If you are purchasing, they do need to be paid. So we would look at like how much you have saved for down payment and closing costs, and perhaps manipulate those numbers a little bit to see, okay, if we pay off the taxes, this is what's left over. What can we do with this? And then there's some strategies we can employ in there if you don't have enough for closing costs, perhaps.
Right. Okay. So let's maybe shift into property tax questions. I know that some people have or don't even think about this actually as questions. And so it does, I think, make an impact on things like this. So do lenders require property tax statements?
Every single file, basically, there's some component to property tax. So if we're doing a renewal or refinance, we do need a property tax statement, and we do need to show that they are up to date. If you're doing a purchase, they're going to want to see how much the property taxes were for the previous year, or for if it's later on in the year, so like around June, July, when they issue those year-end statements, they'll want to see what that looks like. Sometimes we will see MLS listings with outdated property tax information. So like what we were seeing this in 2025. We were well into 2025, and some listings still had 2024 or even 2023 property tax amounts.
Okay.
So we do need to definitely know what the property tax amount will be. And like I said, if property taxes are past due and you're doing a renewal or a refinance, those do need to be brought up to date.
Right. That makes total sense. Another question that I get asked, and I'm like, this is not a question for me, but is it better to have property taxes included in your mortgage payment, or should you pay them separately? Or is it just like a case-by-case basis?
You should try to pay them separately if possible. It is the easiest and best route moving forward. There's a lot of complexity that kind of gets built into it. The lender has to have like a reserve account for you, and not even simplicity from their side, but like for the borrower themselves, it gets confusing. If you want to move to a different lender and you've already paid some of your property taxes, it gets issued back as a credit, but now you have to pay for the rest of the year's property taxes yourself. But they're still collecting those property taxes on your behalf because they need a reserve amount for the following year. So it feels like you're double paying your property taxes, and it just gets really confusing. So we try to encourage where possible for you to be directly responsible for your property taxes. And you can contact whatever municipality for where you live. And generally they will have payment plans. So most people can make them monthly or biweekly, whatever works best for them, instead of having those large quarterly installments that people tend to fear. And it can make it so much easier just overall. And just as a side note, a lot of lenders are actually stepping back from collecting property taxes, depending on who, like if you've had them collected the whole time, you may be like grandfathered in. But if you want to move to a different lender and have them collect your property taxes, on the A side at least, most of them don't want to do it.
Right. Interesting. Yeah, because I know that we still have our taxes inside of our mortgage too. So that's interesting. So how do property taxes impact how much house somebody can afford?
So generally when we're doing a pre-approval, we would just kind of like ballpark what property taxes might look like on that type of purchase price. But if property taxes are higher than we estimated, then what you qualify for comes down. It's like any other monthly bill. Like it is factored into our calculations and it's considered a liability. It's something you're responsible for on a monthly basis or on an annual basis for the price of home ownership. So it, depending on whether property taxes are higher or lower than your original pre-approval kind of estimate, that will determine what happens with your purchase price. And also, just as a side note, if you're adding condo fees in there too, that also significantly drops what you qualify for. So when you're doing a pre-approval, it's important to know what that baseline is and then how your purchase price will fluctuate accordingly. So generally what I suggest is when I do pre-approvals for people, I will tell them up front, this is kind of what we're estimating for property taxes. If there's a property you're interested in, send me the listing. I'll take a look at it. I can tell you based on those property taxes and that specific property, what you can be pre-approved for or what I think is doable with your numbers, and then go from there. So I will do it on a case-by-case basis for every single property if needed. I don't mind doing it.
And I think too, it comes down to like the realtor and the mortgage person collaborating in that sense too, because if you're like, because the taxes are higher, they're going to have to get this house for less in order to make this work, right? So sometimes that negotiating power is a key element to being able to make that work for the buyer. And so, yeah, so a lot of people, I don't think, realize that impacts their pre-approval. So that is good information to know. Do you have any questions that are pressing that you seem to be repetitively asked that we haven't addressed yet?
The only one that we really haven't addressed is just timing on property taxes. So right now we're pretty early in the year, so most people would have received their first interim billing from the municipality for property taxes. When we ask for a property tax statement at this point in the year, we generally still want to see the year-end property tax statement for the previous year. So in this case, 2025's final billing, so we can indicate what the whole amount actually was that they paid. most lenders won't accept interim billing. Sorry. So that is probably the most common thing right now. So I just indicate when I'm asking for a property tax statement, we're looking for that 2025 year end just to make it easier. But many people will think, oh, well, this is the one that I just got. This is what they need to see. It's not. We need the full annual billing amount.
Now, just as a question in conjunction with that, do you actually need a physical piece of paper, or can the homeowner call the municipality, get the exact amount, and just relay that to you?
No, we need to see the actual document. So if they can't find it, they can contact the municipality and request another copy. Usually there's a fee associated, and that varies depending on the municipality. But we do need the actual statement. It can't just be relayed to us. We have to have a way to prove it to the lender and say this is what they paid. Anybody, like someone could call and say, oh, well, they told me it was $2,000 last year. We would need some kind of proof.
Yeah. And it's good, I think, too, for the realtor who is listing a property to have that available so that the buyer's lender can utilize that. So that's an important part, I think, too.
On occasion, we may have a lender that asks, so if we're in a purchase scenario, we may have a lender that does ask us to reach out to the realtor for the previous year's property tax statement.
Right.
It's not super common, but it does happen sometimes. So please don't be taken aback if we ever contact and ask for it. It's just because the lender's requiring it.
And I think too, that just comes down to the preparation stage of the listing agent. I mean, that should be standard practice anyways, because it's necessary for the listing itself. So, okay. Real life scenario questions. So, what if I just retired? How do taxes affect my approval?
So if you just retired, we can no longer use your employment income. So it's kind of a tricky spot. If you've been retired, usually in order to be able to use that income, we need to see 3 months deposits into your bank account. It's not necessarily based on your taxes at that point. So we really do need to see at least a short history of you receiving those deposits. So that's where bank statements come into play.
Right. Okay. So that would be like their retirement fund funding their living situation.
Like your CPP, your OAS, pension deposits, that kind of thing.
Okay. If I'm downsizing and have equity, do taxes matter as much?
Only if you're self-employed. So same kind of situation as before. If you're hourly or contract, any of those things, we can get away with 2 years T4s. We don't actually have to see that, like your notice of assessment, and see that your taxes have been completed.
Okay, perfect. What if I had a rough income year, but things are improving?
Sometimes we can get that done on exception. It just really depends on the story behind it. So, I mean, if you were off sick from work, you were, disabled for a period of time or whatever the case was, and maybe you're back to work now, those types of scenarios are far easier to explain to a lender. The person was sick or injured. They were off for 8 months. They're back to work. Here's their letter indicating what their current income looks like. Here's a most recent pay stub showing they are fully back to work. That's no problem.
Right.
If they're self-employed and it's more commission-based, we'll run into more problems there. We may have to look at a bank statement approach with like potentially an alternative lender, depending on what that looks like. But there are usually different ways we can look at it. It's kind of a case-by-case basis.
Yeah. Okay. Can I still qualify if I changed jobs recently?
So that would depend. If you're in the same industry as you were before, so very similar kind of title that you have, sometimes we can get an exception to use an average there. If you move into a salary or hourly role where it's guaranteed income, generally we just need to see your letter of employment and most recent pay stub. So you need to have at least one pay stub before closing, and usually that will be okay. Sometimes it's an exception, depends on the lender, but those are things that we can get done.
Okay, perfect.
Now, I will say it's a completely different job field and it's not guaranteed hours. So say you've gone from being perhaps a retail worker to now you are working in construction and your hours aren't guaranteed because it's a seasonal position. We're going to need to see a 2-year average for that. We won't be able to use the income.
Okay. This one's a tricky one. I never understand capital gains. But do capital gains affect mortgage qualification?
Not from our side of things for the most part. It's more from like a tax planning perspective. So that's something you'd want to talk to your accountant about. It doesn't really impact your pre-approval.
Okay, perfect. So 5 more questions. Will CRA show up on my credit report?
Not that I've ever seen. So like if you just owe regular taxes, no, it would not show on there. It would be more so like if you've gone to collections for not paying,
Right.
then that would be on your report.
Okay. So that kind of sort of like, can owing taxes ruin my approval at the last minute? So if you've maybe done a deal and you're kind of just pending, and then you do your taxes in between and then you owe taxes, is that going to affect the approval?
Depends. So if you're not self-employed and you've recently done your taxes and now you owe money, if there is nothing that shows the lender that you owe the taxes, then no, I mean, it should be fine. But if you then indicate to us that you owe money for your taxes, they're going to need to be paid. And if you don't have a way to pay them, then yes, that can derail your approval.
Okay.
If you're self-employed and you suddenly owe taxes, if it depends on the lender. So if we're like really close to funding and you've just done your taxes, they might come back and say, hey, we want to see your new statement of account to make sure you don't owe anything. And then yes, you would be responsible for paying those taxes. If they don't ask, then you can likely get by if they don't ask. And it really just depends on the lender and what they're comfortable with.
Right. Okay. And would B lenders be more picky than A lenders? That's a question I've always kind of wondered.
Sometimes it really just depends. It's so hard to say like as a blanket statement.
Yeah.
I do find B lenders to be a little bit pickier with some things. Right. Sometimes A lenders will let things slide, whereas B lenders may require more documentation, but then other times they are more lenient for certain things. So it is kind of hard to make a blanket statement there.
Always.
Yeah, it's file dependent. Yeah. I'm sorry.
What's the biggest tax mistake people make before applying?
So like personal tax wise, I don't really see many mistakes there. Okay. It's more so because again, if you're not self-employed, often we don't even see what your taxes look like. So it's not a huge deal, not really many mistakes to be made there. From a self-employed perspective, again, just coming back to not introducing your mortgage agent or professional and your accountant, not having that relationship between the two can be a mistake because your accountant's job usually is to make it so that you owe the least amount in taxes. That doesn't always work on the mortgage side of things. So having that connection or lack of connection, I think would be the biggest mistake because it's not working together for your best interest. If you connect them early, then we can work together as a team to make sure that it makes sense.
Yeah, for sure. Should I wait to buy until after tax season?
Again, just depends on if you're self-employed or not. If you are self-employed, yes, I would wait, just so that you know how much you owe, whether you can pay that up, and also so that you can, again, facilitate with your mortgage agent and your accountant to make sure that your taxes are filed in a way that will improve your odds of a pre-approval. If you are just regularly employed, you don't really have to wait.
Okay, perfect. And then this one isn't necessarily like tax related in a sense, but, and I love this because this is like, people need to know this. What should I not do before getting pre-approved?
Oh, thanks. Don't buy a car that's really expensive.
Yeah.
That $400 monthly car payment decreases your qualification amount, usually on average by about $100,000. So these people have like $400 bi-weekly that they're paying toward a car. And I mean, that's not completely insane these days. Like it's a pretty common car payment. $400 bi-weekly, that's like $200,000 that you're decreasing your pre-approval by, which is insane. So buying crazy expensive cars, and even during your pre-approval period, don't buy furniture for your new house, even if it's on like one of those buy now, pay in 2 years kind of situations.
Cards.
Yep, don't do that because it does show up on your credit report. It does count against you. Don't move your money around unless we specifically tell you to move it, because then you're creating more work for yourself. You have to provide 3 months bank statements or a paper trail for everywhere that you've moved your money. So don't move it. Leave it where it is until we tell you otherwise.
Yeah.
And make sure you continue to pay your bills on time. Even if we're doing a refinance where we're paying out debts, unless we specifically tell you not to pay something, continue to pay everything because it will reflect on your credit. Don't apply for a bunch of credit cards. Just don't do it.
So say in the middle of the pre-approval stage, your bank says, hey, we want to give you we want to add $40,000 to your credit card, or we want to increase your limit by 40,000. Is that a no-no?
Generally, just don't do it. There's not really a need for it in the midst of the pre-approval process, and you run the risk of it just causing problems, especially if you need to use it and it wasn't something we were anticipating. If by some chance your bank offers it to you, you've been pre-approved and you don't know any better and you take it, just don't use it. If it's at a zero balance, more often than not, we don't have to count a monthly payment for it. So just don't proactively start going and applying for things, because it reduces your credit score and it looks like you're credit seeking, which we don't want.
Right. And then, but as soon as they get their keys, everything closes, they're good. Like they've moved into their house. Essentially, it's game on. Go do your thing.
Yes. Essentially, after you've closed and you have keys in hand, at that point, you can make changes, apply for a new credit card, do what you need to do. And one other thing I forgot to mention in the process, if you don't have to change your marital status, don't. If you don't have to quit your job and change, don't. Those type of things will make it very difficult, especially when we're right in the middle of the process. I did have someone who quit their job and started a new one in an unrelated field in the middle of it. This was for a refinance, but we couldn't even finish it because we're like, you changed jobs. And now they're trying to call this other employer, not knowing that they quit their job, so they didn't even tell us. So it's a big problem, and like it looks like you're hiding information and you're not being forthcoming. And now we don't have a track record of that income, so please just don't change jobs in the middle of it.
Yeah, for sure. Even if it's like a better paying job, just like delay it if you can, or
it depends on how far we are into the process, and just come talk to me first. I can often say, okay, same industry, it's a salary position, you're making $40,000 a year more. We still have 2 months until closing. We have time. Let me take this to the lender first and see what they want. If it's just letter of employment and pay stub and we can have those things in place, sure, it sounds doable. But if you're telling me you're going from a salary position to a contract position, don't do it. I can give you that advice, but you have to come to me and tell me so I know what's going on.
That's a huge part of the buying and selling process, even the refinancing process, is that communication is key, because if we don't know what's going on, we can't stop you from making a bad decision. We can also encourage you to make a good decision. But if you just go ahead and make these decisions and thinking that you are, you're doing the right thing or whatever, and you're in the midst of it, I would very much highly recommend that you communicate with your mortgage person, your accountant, your realtor, so that we can just guide you from a professional standpoint, because we don't want to see you mess up your closing or not be able to close because of a silly decision on buying a car in the midst of it or something. Which that information of a $400 a month car payment reducing your approval by $100,000, that's crazy to me. Yeah, that's a very good information to know, because I don't think very many people probably know that.
No, I had created a short video on it before, and I did get a fair bit of traction because people just don't realize. And it is so common to have a car payment now. So things that we can look at to mitigate that if it is an issue. So say a couple of years ago you bought a car, you've got $10,000 left owing on it, and you have a $400 or even like an $800 payment on it. That $10,000, it makes more sense to pay it out in that case if it's possible, because it's going to improve your qualification. So if you have a larger down payment than needed, we may take some of those funds and tell you, pay the car instead, it's going to help you qualify for more, and we can get you still approved with the down payment you have left. Sometimes we can also look at a cashback mortgage where you get cash back on closing that you can use to pay a debt. So depending on what that looks like, it does come at a higher interest rate and usually a 5-year term. So it doesn't work for everyone, but it can help in some scenarios where you really need to get into this house. This is the one you've been looking for your whole life and you finally found it. We can look at things like that to get you into the market. So cashback mortgage potentially to pay out a debt that's hindering you.
And I believe, and again, this is just my opinion, so don't criticize me, but I believe that working with a mortgage professional like Melissa, going above and beyond and being creative with all of these things, I do not believe, somebody at the bank is going to be as open or as willing to do these kinds of things for you, because it takes work and it takes effort and it takes time, and it takes compassion as well. And I'm not saying anybody that works at the bank is not compassionate. I am not saying that. But I do think that you need someone who is really going to give you a customized approach that is geared to you specifically, your scenario, and what's best for you. So just keep that in mind. I always say go and get your opinions and your rates and whatever from whoever you need. Not too many because they're going to all check your credit, but you definitely want somebody like Melissa on your side because she's going to have your back throughout the whole process. So it's important to have somebody like that with you along the way, along with a great realtor. And I'll toot my own horn here. And this is why we do these things, is to help educate you so that you are not making bad choices. As I tell my 6-year-old daughter all the time, was this a good choice? No. And we're here to help guide you through this. And usually this is, one of the biggest investments that you have. So we want to make sure that you're doing everything you can the right way. That's going to benefit you long term. So we do these every single month. We've got previous calls up on YouTube. So you can go to rewithme.ca to rewatch those or follow us on socials. You can find us both there and reach out if you've got, specific questions. I will connect you with Melissa, or if you have a real estate question, I'm happy to answer that as well. But it's just really important that you're getting this education so that, again, you can make great real estate choices. So we're here. We'll be here next month as well. And we would love to have your questions and work with you. And can't wait to see you again. Thanks so much.
Thanks for having me.